In this video, I'll provide a complete review of DHHF, a popular all-in-one ETF listed on the ASX. Let's get straight into it. DHHF is an all-in-one ETF with 100% allocation to shares tracking the entire global stock market. The fund invests in a blend of large, mid and small cap equities from Australia, global developed markets and emerging markets. This provides investors exposure to an all-cap, all-world share portfolio with potential for high growth over the long term. When you invest in a single share of this ETF, you essentially own a tiny portion of the entire global stock market. DHHF is issued by BetaShares, one of Australia's leading ETF providers. Since its launch on the 3rd of December 2019, this relatively new ETF has quickly gained popularity, particularly among young Australian investors. This fund currently manages around 740 million in assets. This term is known as assets under management, which is a measure of how much money has been invested into the fund. A higher AUM generally indicates greater trust in the ETF. DHHF is domiciled and registered in Australia for tax purposes, meaning Australian residents are subject to local taxes and regulations. This local domicile offers two key benefits for Australian residents. 1, they can avoid foreign tax complications, and 2, it allows them to set up a dividend reinvestment plan to automatically reinvest dividends into more shares. DHHF contains approximately 8,000 companies listed over 60 global exchanges. It is split into 4 main asset categories. Around 37% is made up of Australian companies, 40% is in US companies, 17% is in companies from developed markets excluding the US, which includes countries like Japan, Canada, and Germany. And the remaining 6% is made up of emerging markets like China and India. Here is a full breakdown of the allocation by country, with the United States and Australia making up the majority of the ETF. The sector allocation includes approximately 24.2% financials, 13.8% IT, 10.2% industrial, 9.9% healthcare, and 9.4% consumer discretionary as a top 5. Various other sectors make up the remaining allocation. Let's now check out how DHHF has performed over recent years. You can go to the DHHF BetaShares website and click the Performance tab. Here you can view the performance data in both table and chart format. I personally prefer looking at the table view. The performance data shows returns across multiple periods: 1 month, 3 months, 6 months, 1 year, 3 years, 5 years, 10 years, and since inception from December 2019. As of the 30th of May 2025, this ETF has delivered an average annual return of 14.85% over the past year and 13.19% over the past 3 years. Since the inception date was in December 2019, DHHF hasn't reached a 5-year mark, so we don't have data for the 5 and 10-year returns. However, it has delivered an average annual return of 11.44% since inception, which was nearly 5 years ago. These returns are calculated after management fees and assume all dividends are reinvested. There are 2 ways to make money with stocks. First, through share price appreciation. For example, if you own 100 DHHF shares at $37 each, which is $3,700 in total, and the price rises to $40 a year later, your shares are now worth $4,000, giving you a $300 profit. And secondly, you make money through dividends or distributions. When companies within the ETF pay dividends, the ETF must distribute these to the shareholders. While companies aren't legally required to pay dividends, ETFs must pass along any dividends they receive to their shareholders. So the performance return includes both share price appreciation and reinvested dividends. One last important thing I want to note, these figures represent average annual returns. Please note, average. For example, while DHHF has returned 11% annual returns since 2019, this doesn't mean a steady 11% growth each year. As you can see in the chart, some years saw gains, others had losses, and some showed minimal changes. It wasn't a straight line growth. But over the long term, the fund has grown at an average rate of 11% annually. This is important to understand, as I often see new investors looking at an ETF's historical performance and expecting identical returns year after year. That's not how it works. You can find dividends or distribution information in the distribution history on their website. Simply click the distribution tab on their website to access this page. This ETF pays distributions quarterly, so 4 times a year, with a 12-month distribution yield of 2.2%. This yield represents the total dividends paid to investors over the past year as a percentage of the current share price. Please note, this dividend yield percentage isn't guaranteed, it fluctuates based on quarterly dividend payments. Looking at the recent distribution history, the last payment was made in April 2025 at approximately 11 cents per share. So this means if you owned 100 shares of DHHF, you would have received around $11 in the last quarterly payment. Here are the key terms to understand. The ex-entitlement date, also known as ex-dividend date, marks when the stock begins trading without the dividend. New buyers after this date won't receive the upcoming payment. The record date is when DHHF determines share ownership for payment purposes. The payment date is when shareholders receive their distribution. Distribution units, or sometimes known as cents per unit, indicates how much you'll receive per dividend share. Since DHHF is domiciled in Australia, you can set up a dividend reinvestment plan, or DRP for short. This automatically reinvests your dividends into more shares, typically at a small discount. You'll need a CHESS-sponsored broker to set up DRP through your share registry. If you want to know how to do this in more detail, I'll leave a link to a video I made in the description below. And just a quick note on the proper terminology, while dividends and distributions refer to the same type of payment, they're technically used differently. Companies pay dividends to investors, while funds like this ETF pay distributions. Since DHHF receives dividends from companies and passes these payments to investors, they're technically called distributions, although the terms are often used interchangeably. Let's now look at some alternatives to DHHF and compare them. There are two all-in-one style ETFs that are often compared with DHHF. The first one is the Vanguard Diversified High Growth Index ETF, ticker symbol VDHG. VDHG by Vanguard offers a diversified portfolio with about 90% in growth assets and 10% in fixed income. It invests in over 16,000 securities across Australian and international markets, making it suitable for investors seeking a balanced approach with some income stability. Like DHHF, it's an all-in-one ETF investing in the global stock market. The key difference is the 10% income allocation, which reduces volatility. And the second one is the iShares Global 100 ETF, ticker symbol IOO. IOO by iShares tracks 100 multinational blue chip companies, offering concentrated exposure to global leaders, especially in the IT sector. In simple terms, it tracks the world's top 100 companies. While it's not as diversified as DHHF or VDHG, it still technically offers exposure to the global stock market. Looking at the comparison table on screen, here are the key differences between these ETFs. They are issued by BetaShares, Vanguard, and iShares, who are the three most popular ETF providers in Australia. They're all well trusted in the Australian finance community. From their inception date, you can see IOO has the longest track record at 25 years, while the other two are still relatively new. VDHG leads in assets under management, which isn't surprising given Vanguard's popularity in Australia. DHHF offers the lowest management fee at 0.19%, while IOO charges more than double at 0.4%. Looking at the 3-year average returns, IOO has performed the best. This does make sense given its concentrated portfolio of top global companies, especially in big US tech companies like Microsoft, Nvidia, and Apple, which make up over 30% of the ETF from just these three alone. DHHF and VDHG offer broader diversification, as shown by their higher number of holdings. VDHG's slightly lower performance is likely due to its 10% fixed interest allocation. I've also included their 12 months average franking credit percentages for your reference. While most investors don't choose these ETFs primarily for dividends, they are a nice bonus. Please note that while these ETFs are similar, they are not like for like, so therefore they are not direct alternatives to each other. Each has its own unique investment strategy, so I would encourage you to do more of your own research. Let's now look at some pros and cons of this ETF, starting with some of the pros. 1. High long-term growth potential. DHHF is 100% invested in growth assets, providing an investment option with high growth potential over the long term. 2. Global diversification. The fund is designed as an all-in-one investment ETF that provides exposure to approximately 8,000 companies across 60 global exchanges, encompassing large, mid, and small cap equities from developed and emerging markets. 3. Simple set and forget approach. As an all-in-one ETF, it eliminates the need for manual portfolio rebalancing, offering convenience for those who prefer minimal maintenance. You can simply invest in it regularly and know that you're well diversified with a single ETF. 4. It's cost-effective. With management fees of just 0.19% per year, it's among the lowest fee diversified all-in-one ETFs currently available on the Australian market. Now, no ETF is perfect, so here are a few cons. 1. High volatility. The absence of defensive assets like bonds means the fund can experience substantial fluctuations during market downturns. This volatility may not suit investors with lower risk tolerance or those nearing retirement. 2. Limited income focus. With a relatively low dividend yield, DHHF may not be ideal for income-focused investors. Its primary objective is capital growth rather than generating regular income. 3. Potential overlap with other holdings. Investors who also hold similar ETFs or shares may find overlapping exposures, leading to less diversification than anticipated. 4. High risk. Given its exclusive focus on growth assets, this is labeled as a high-risk investment on their own website. Investors should be comfortable with significant market volatility and have an investment horizon of at least 7 years. For more detailed information about this ETF, you can visit their website, which contains everything I've covered in this video and more. I strongly recommend doing additional research there. You can also download their fact sheet, which offers a concise overview of all the key information in just a few pages. And quick disclaimer, this video is for educational purposes only and should not be considered financial advice. The ETFs I mentioned in this video are not buy recommendations and are used as examples only. Always do your own research. Investing involves risk, and past performances does not guarantee future results. If you would like financial advice, please go talk to a professional. By the way, if you're enjoying this video and made it this far, comment the word diversified down below so I know who you are. And if you're new around here, what are you waiting for, mate? Hit that subscribe button and join this amazing community of like-minded people. Also, please consider signing up for my free newsletter, Aussie Money Club, where once a week I'll send you some money tips, major news in the market, or any cool live updates from me. And if you want to learn how to invest in ETFs this year, check out this video on screen where I'll show you a step-by-step beginner's guide on how to buy your first ETF in Australia. And as always, thank you for watching, I appreciate you, and I'll see you in the next video.